Poor countries pay 400% more interest than America. The United States borrows at 3%. Developing nations pay 12%. Same money, same markets, 4 times the cost. And it's not economics, it's not risk. It's a system designed to keep poor nations poor. Because since 2020, developing countries have been paying 2 to 4 times higher interest rates than the US. And in 2023, they paid $25 billion more in debt servicing than they received in new loans. They're going backwards, paying more than they borrow, trapped in perpetual debt. This is debt slavery by design. And today, you're going to learn exactly who profits from keeping billions of people trapped in poverty. Let's start with the numbers. The United States borrows at roughly 3 to 4% interest. Germany borrows at 2 to 3%. Japan borrows at under 2%. These are developed countries with massive debt loads. Now look at developing countries. Ghana borrows at 10 to 15%, Zambia at 12 to 14%, Pakistan at 9 to 12%, Kenya at 11 to 13%. Countries with smaller economies and less debt pay 3 to 4 times more interest than rich countries drowning in debt. The justification? Risk. Poor countries might default, so lenders charge higher rates. But here's the reality. The US has $36 trillion in debt. Japan has debt at 250% of GDP. These countries are far more likely to face a crisis than a small African nation with $10 billion in debt. But they pay less because the system is rigged. Credit ratings favor rich countries. Global financial institutions give preferential treatment to developed nations. And developing countries are charged premium rates, not because of risk, but because they have no choice. Here's where it gets truly evil. In 2023, developing countries paid $25 billion more in debt servicing than they received in new loans. Read that again. They paid out more than they took in. They're not borrowing to invest in development. They're borrowing to pay interest on old debt. It's a hamster wheel. Borrow money to pay interest on previous borrowing. Watch the debt grow. Borrow more. Pay more interest. Never escape. And who collects that $25 billion? Western banks, international financial institutions, wealthy creditors in developed countries. The wealth flows from the poorest nations on Earth to the richest investors on the planet. This isn't aid. This isn't development. This is extraction. Let's do the math on what 12% interest actually means versus 3%. Country A borrows $1 billion at 3%. After 10 years, they pay $344 million in interest. Total cost, $1.344 billion. Country B borrows $1 billion at 12%. After 10 years, they pay $1.13 billion in interest. Total cost, $2.13 billion. Same loan. Same amount. One country pays $344 million. The other pays $1.13 billion. That's not risk pricing. That's systematic wealth extraction. And it compounds. Higher interest means more of the budget goes to debt service. Less money for schools, hospitals, infrastructure. The economy grows slower. Credit ratings drop. Interest rates rise even more. The death spiral accelerates. Meanwhile, rich countries borrow cheap, invest in development, grow their economies, and maintain low rates. The gap widens by design. So who's collecting these premium interest rates from poor countries? Western banks, JP Morgan, Goldman Sachs, Citigroup. They underwrite bonds for developing countries and collect massive fees. They also trade those bonds at higher yields, profiting from the interest rate spread. International financial institutions. The IMF and World Bank lend to developing countries with conditions that often require borrowing from private markets at high rates. They act as gatekeepers, forcing countries into expensive private debt. Hedge funds and vulture funds. They buy distressed debt from poor countries at pennies on the dollar, then sue for full repayment plus interest in international courts. They've made billions extracting payments from countries that can't afford food for their citizens. Wealthy individual investors. High-yield emerging market bonds are popular among rich investors seeking better returns. They earn 10 to 15% returns, while teachers in Ghana can't get paid. The entire global financial system is structured to extract wealth from poor countries and deliver it to rich investors. The International Monetary Fund deserves special attention. They claim to help developing countries. They provide emergency loans. But here's the catch. IMF loans come with conditions. Austerity measures, cut government spending, reduce subsidies, privatize public services, open markets to foreign competition, basically dismantle the economy to ensure loan repayments. So a country in crisis takes an IMF loan to avoid collapse. The IMF forces them to cut spending, which kills economic growth. Now they can't repay, so they take another IMF loan with harsher conditions. The cycle continues until the country is completely dependent on IMF loans and Western creditors. And the entire time, they're paying interest rates 2 to 4 times higher than developed countries. The IMF enables the extraction while pretending to help. China saw this system and offered an alternative, Belt and Road Initiative loans with lower rates and fewer conditions. Developing countries jumped at the opportunity. Western media immediately called it debt trap diplomacy. The irony is stunning. Western institutions have been running debt traps for decades, charging premium rates and forcing austerity. But when China offers better terms, suddenly it's a problem. Yes, China's loans come with strings, but at least they're building ports, roads, and infrastructure. Western loans just service old debt while extracting wealth. Let's return to the central scandal. $25 billion net outflow in 2023. Developing countries paid more to creditors than they received in new loans. That's $25 billion that could have built schools, hospitals, clean water systems. Instead, it flowed to bondholders in New York, London, and Frankfurt. Teachers went unpaid so hedge funds could collect returns. This has been happening for years. Developing countries as a group have been net payers to rich countries. The direction of wealth flows backwards. Money moves from poor to rich. Development aid is a myth covering up systematic extraction. Credit rating agencies, Moody's, S&P, Fitch, rate developed countries higher despite massive debt loads. The US maintains AAA or near AAA ratings with $36 trillion in debt, but they downgrade poor countries with far less debt. Why? Because credit agencies are paid by bond issuers. They're based in developed countries. They protect the interests of Western creditors. A good rating means lower interest rates, which hurts investor returns, so poor countries get downgraded to justify higher rates. It's a rigged game. The referees work for the home team. Developing countries pay 2 to 4 times more interest than the United States. Not because they're riskier, because the system is designed that way. In 2023, they paid $25 billion more in debt servicing than they received in new loans. Money flowing from the poorest nations to the richest investors. Teachers unpaid. Hospitals underfunded. Infrastructure crumbling, so bondholders can collect 12% returns. Rich countries borrow at 3%, poor countries pay 12%. It's not economics, it's not risk management, it's extraction. It's colonialism by debt. The global financial system keeps poor nations poor, not through military force, through interest rates, credit ratings, and debt traps. Legal, structured, permanent, and who profits? Western banks, hedge funds, wealthy investors. The IMF claims to help while enforcing the system. This is debt slavery. 400% higher interest rates, 25 billion in net outflows, billions trapped in poverty by design. Welcome to global finance, where poor countries pay for rich countries' prosperity forever.